Hi, everybody. I hope that you all are connected now.
Good morning. Hi.
And good morning, Nishan. Thank you. And by the way, if you don't know me, I'm Sujeeva Rajapaksa. I'm the managing partner of BDO. Hope everyone who have got connected and others who are going to get connected are safe. That is very important at this moment. And let me thank each one of you for registering with this BDO webinar, COVID-19, financial reporting implications and guidance, which is absolutely important. And as you are aware that there are a lot of measures taken to contain the virus, which has completely affected our economic activities, and which in turn has a lot of implications especially in financial reporting. When it comes for financial reporting, it's not only reporting as well, because we being BDO being the a large firm of chartered accountants, we also carry out quite a lot of audits for listed and various other companies. So it's financial reporting from your side, ladies and gentlemen, and from our side, it's for auditing as well. And as we are aware, this COVID-19 has given us quite a lot of challenges. One would be we are basically limiting the movements of ourselves. So we can't see each other. We can't go to work. We can't start our own, the production or services. And also you are aware, if you take international, because every country you need international connections, international relations, and there are restrictions of flight movements. As a result, you may not be able to see each other, and go to each other, and even to negotiate your business deals with others. Also, there will be quite a lot of different new thinking about the way that you are going to do your business or provide your services, because in the meantime there will be some time closure of our businesses as well, because it's too early for us to look at how things are going to happen. In the meantime, this COVID-19 has impacted on our businesses. This will anyway further, have an impact to our supply chain, our businesses, and our creditors, our debtors, our other relations, related parties, and all other stakeholders. Our activities will be completely changed. In the meantime, our business model, our business appetite might change, and also as a result, our business direction also might get impacted, which is absolutely again important. As a result, there's going to be a major impact to our production processes and our service lines, and which obviously lead to lowering the economic activities, again resulting lowering demand for services and goods. This we expect this might happen at least over next 1 year. You are aware that the financial statements ending 31st March, obviously there's going to be a major impact. Even December account, those who are not finalized, is going to have some kind of impact. Management of the business also should be carefully consider the impact of this COVID-19. Obviously, everything boils down to financial statements. So implication for financial statements include, it's not only the measurement of assets, it's not only the measurement of liabilities, not only the measurement of revenue or expenditure, but disclosure is absolutely important, that we need to understand. As a responsible firm of chartered accountants, BDO Group, we have been in touch with you all last, let us say, especially 1.5 months, especially there are a lot of announcements and circulars and things like that from various regulators, and our team actually within a shortest possible time we have been able to share those with you all, and we will continue to do that. And we understand the value of our clients and those who are going to be with us, even new clients who are going to be with us, which is important. Nishan will certainly, I don't want to take it to Nishan's side, but to take it to Nishan's presentation, but I know Nishan is going to discuss very important things, and Now, the looking at from the entrepreneur's point of view, going concern is very important, because we hear a lot of businesses are going to be completely changed or sometime completely closed. And you are aware, even Australia, one of the largest or the second largest airline is, I think they have declared for bankruptcy, or the bankruptcy, that is Virginia. And as a result, there'll be a lot of events after the reporting date, which we will have to capture all the events which are going to be substantial. Then assets will be impaired. Sometimes assets will be completely it's going to be obsolete because of the fact that you may change your system. Now we are talking each other from distance. Sometime in future we may not need boardrooms and things like that. So those obviously, as auditors, BDO will come to you and ask, look here, what are you going to do? There are a lot of important things. So therefore, please remain with us. I think Nishan is going to take you through about hour and a half, I believe. So Nishan is, I don't want to introduce Nishan. Nishan is my deputy managing partner, Ashen Jayasekar. Anyway, he will introduce Nishan, and Ashen is also my deputy managing partner, as well as he looks after our risk advisory, forensic, the audits and IT audits and things like that. Over to you, Ashen. I hope that you are connected. So, right.
Yes.
You have changed.
Hello,
I'm sorry, I thought someone else. I thought that you are a client. You have grown up your beard.
Yes, yes.
Great. Okay, thanks, Ashen. Thank you.
So
Okay,
hello,
all
everyone.
and have a pleasant morning to everybody.
Good morning. I would like to introduce our presenter, Mr. Nishan Fernando. I will give a very, very brief introduction. He, of course, needs no introduction, but nevertheless, I will tell a few things very briefly about him. He's a fellow of the Institute of Chartered Accountants, and currently he's the managing director of BDO Consulting Private Limited. He has been a past president of the Institute of Chartered Accountants of Sri Lanka, and currently he chairs the IFRS Interpretation and Implementation Committee at CA Sri Lanka. It's a very, very important committee. He also serves as the vice chairman of the Asia Oceania Standard Setters Group of IFAC, which is a global professional accountancy body. This is, of course, a very prestigious position and a great honor for Sri Lanka. And apart from that, he has been a past chairman of the Sri Lanka Accounting Standards Committee and a board member at SLASMB, that is, of course, the Sri Lanka Accounting and Auditing Standards Monitoring Board. So we are delighted to have him here with us today, and his presentation would last for about 60 minutes, followed by a Q&A of 20 minutes. And if you do have any questions, you can post it to the chat box. I believe it's on to the right side of your screen. You can post it there, and my colleagues Gerard, who is a director in audit, and Buddhi, senior manager in corporate finance, will collate these questions, and I will present it to Nishan during the Q&A. So I hope all of you will enjoy this session, and now I would like to invite Nishan to commence his presentation. Over to you, Nishan.
Thank you, Ashen. I hope all of you can hear me. Yeah. So I think I don't have to spend too much time for any introduction about the background of this presentation and the background situation in the world today. Mr. Rajapaksa has quite extensively done that. So as you are all aware that COVID-19 outbreak, which started probably towards the end of 2019 and got the hype in early 2020. If you look at probably up to end of 2019, there were very few events and actions, probably confined to China and few other countries. But towards early 2020, World Health Organization announced coronavirus as a global health emergency on 31st of January, and probably that would have been a trigger that would have been a trigger for most of us to think about coronavirus or COVID-19 seriously. And in towards end of the first quarter 2020, most governments and organizations started taking various actions about this outbreak. So that is very briefly is the timeline which the standard setters have taken into consideration, particularly in deciding what is the cutoff date, for example, for post balance sheet events. What is post balance sheet and what is on balance sheet, kind of. And as you know, now we all have understood that the effects of COVID-19 are widespread. Sometimes we have experienced reduced consumer demand for goods and services. On one side, maybe due to loss of income for the consumers, and also maybe due to their due to restrictions on their ability to move freely. And there is a significant reduction in investment in capital improvements, capital projects, and that has reduced a lot of demand for many goods and services. And reduction in market prices for commodities, financial assets, including equities and certain debt instruments. Interest rates are coming down, so borrowers may be happy, but on the other hand, those who have savings, their income levels will come down. In turn, that could have a negative effect on the demand side. And also we can see disruption of global supplies. Supply chain disruption can be seen to a very large extent because of the restrictions that have been placed on the movement of people and goods. And internationally, we can see that most of the airports have been closed, and as a result, a movement between countries have got significantly restricted. So all these impacts finally will have to end up at one place. Those are financial statements, whether it is reduction in income, increase in costs, lack of investments, and anything in relation to various organizations need to be looked at and reported for the benefit of the users of financial statements. Now, when it comes to financial reporting implications, those are very broad and need to be considered on a case for each entity, because the implications of this for different entities may be different. And with the elapse of time, more and more information would be available. So such information need to be considered in arriving at various estimates for the purpose of financial statements. And as I said before, there could be a difficulty in distinguishing pre and post balance sheet events. So that need some greater attention when it comes to financial reporting. So let's look at some of the significant areas that we may be interested when it comes to financial reporting. Now, worldwide, we can see that there are a lot of publications that are coming up. So similarly, BDO International also has issued various guidelines, various publications with regard to COVID-19 related financial reporting. International Accounting Standards Board has issued certain guidelines which also need to be considered, because we are at the moment working on IFRSs. And considering most of these things, CA Sri Lanka has also issued certain guidelines with specific reference to local circumstances, and in doing so, CA Sri Lanka has given certain practical experience in certain areas of financial reporting. So today we are going to look at 7 significant specific areas, starting with events after the reporting period, going concern, fair value measurement of debt and equity instruments, impairment of assets, measurement of deferred taxes, financial instruments, leases, and few other miscellaneous areas. All these areas may not have practical experience, few of them yes, and in other areas we will be discussing what are the special areas that as preparers, as boards, as management, what are the areas that you should be looking at, and what are the extra measures that you need to consider or take into account in financial reporting, especially because of COVID-19. Right, so if we start with events after the reporting period, the financial world, financial reporting, financial reporters, standard setters, and preparers appears to have considered the 30th January announcement by World Health Organization as the trigger point or the cutoff point for post-balance sheet events. So if we take that as a significant event, the announcement by WHO, then comes in with regard to Sri Lanka particularly, we have 2 very popular reporting dates, that is 31st December and 31st March. So with reference to 30th January announcement, for those who have 31st December year ends, this announcement becomes post balance sheet. And for 31st March year ends, this becomes pre-balance sheet. So that classification is very important, in deciding certain accounting treatments, deciding on certain disclosures, deciding on certain adjustments to financial statements. With regard to Sri Lanka, we know that we became active towards end of March, and during the last week of March, there were certain circulars issued by the government, particularly with regard to financial assistance and financial facilities. And most of the other significant actions were taken in April, in the first couple of weeks of April, and it's going on. So therefore, in the Sri Lankan context, even for 31st March reporters, some of the events may be pre-balance sheet, while few others may be considered as post-balance sheet. So we will look at them as we go on. But the general understanding, general acceptance worldwide is that 30th January is the cutoff date. And that is the COVID-19 related event, major event, so that that would decide which events for an organization is post-balance sheet and which of them would be pre-balance sheet. So considering that, 31st March reporters need to consider all available information up to 31st March 2020. 31st December, of course, most of the entities may have now finalized their financial statements, but both groups of reporters are required to consider all available information up to the date of releasing financial statements, and depending on the nature of such information, if they are affecting any estimates as at the balance sheet date, then those estimates need to be revised, and otherwise those would be considered as post-balance sheet events and certain disclosures may be required. So when it comes to this post-balance sheet events, the information and all of that, it will have an impact on many areas. Now, for example, it will have an impact on fair value models. It will have an impact on impairment models. When you determine the fair value of a particular asset, and for that purpose, you need to forecast cash flows. So which means there is a cash flow estimation when those fair values are determined. And after the balance sheet date, if there is any further information that you will come across, which will have an impact on the estimation of those cash flows, that will become an adjusting event, because the estimation was there on the balance sheet date, and now after the balance sheet date, you have additional information. So that additional information need to be taken into consideration for the estimate that was there in existence as at the balance sheet date. So likewise, it will have an impact on going concern. You made an estimate on the going concern on 31st March or 31st December, and now you have some other information which will have an impact on that going concern estimate, going concern assessment. So that has to be taken into consideration. Deferred taxes. If you have deferred tax assets, recovery of deferred tax assets may have been estimated based on future profit estimations. And now you may have further information on future profit estimations. Of course, we have a separate section on deferred tax. We will look at that when we come there. Then even the simplest item, inventories, when you are estimating net realizable values, you need to consider whatever the information available as at your date of releasing the financial statements. Expected credit loss models, of course, mostly that will apply to banks and financial institutions. And provisions. So any estimates of provisions, warranty provisions, various other liability provisions may have an impact from COVID-19. And leases, it is another significant area because many organizations have started negotiating with lessors about certain concessions, and some lessors have been giving rent-free holiday periods to lessees. So those need to be considered under IFRS 16, and any information that is available after the balance sheet date, if relevant, to an estimate made on the balance sheet date, need to be taken into consideration. So these events after the reporting period is kind of a background item which will have an impact on all estimates that have been made as at the balance sheet date. So as I said, unless there is any significant additional information or information available to the contrary, in Sri Lankan context, CA Sri Lanka has said basically for 31st December 2019 reporters, COVID-19 is a post-balance sheet event, whereas for 31st March reporters, COVID-19 is a pre-balance sheet event. So that is the basic rule, basic understanding. But if there is anything to the contrary, if you have any information to the contrary, then that of course can change. So it is not a hard and fast rule, but it is the general understanding. So what is on the right side, I have already explained. So basically, if the post balance sheet events are providing additional information, that information has to be taken into consideration in revising whatever the estimates made on the balance sheet date. Otherwise, you may need to disclose those non-adjusting events in the financial statements. So anything arising as a result of COVID-19, if you think that information will help the users of financial statements in predicting certain future cash flows and similar items, then such disclosures need to be made. For example, the COVID-19 may be a post-balance sheet event for a December reporter, but let us say, for example, after the balance sheet date, if the organization has lost some of the key customers, and if they are not going to recover the receivables from those key customers, and if that information becomes available after the balance sheet date, even though it may not be a non-adjusting event, it may be required to be disclosed because that will have a large impact on the cash flow projections of the company, of the entity. Right. So then we move on to another very important and also a background area, which is going concern. sorry, right. Now, when it comes to going concern, we have to be very careful when we apply the post balance sheet event principle. And under this current market turmoil situation, where a lot of supply chain and logistics have got disrupted, and there would be significant changes in demand in most of the areas. Sometimes the demand may have increased. For example, if you take healthcare sector, sometimes we might see certain increases in demand, but most of the cases it is the other way. There are serious implications on working capital, and we have seen that government also has been trying to assist in terms of working capital, and also there have been a lot of liquidity issues in the financial sector as well as in other organizations. So this is a time that we know that we have been placing emphasis most of the time on the balance sheets and profit and loss accounts, but this may be a time that you may need to place equal emphasis or even more emphasis on cash flows rather than balance sheets and profit and loss account, because your going concern, ability to operate and all that will be determined to a very large extent by the cash flows rather than the profits that you will report on the profit and loss account. Then for these issues, the management need to respond. They may have to look at alternative sources of funding. They may have to look at what the government is going to give you. And also you may have to look at liquidity management strategies. There could be multiple scenarios in your estimates. So you may have to consider in your forecasting models the weightages and likelihood, the probabilities of those multiple scenarios. And probabilities or weightages with regard to negative or worst case scenarios may be quite heavy. You may have to relook at those probability distributions as part of management response. So with all that in mind, what is the responsibility of the management as required by accounting standards? With regard to going concern, the management is required to consider the existing and anticipated effects of COVID-19 outbreak. Now, CA Sri Lanka guidelines specifically says that normally in going concern assessments, we look at the subsequent 12 months, but in this particular instance, don't limit your assessment to 12 months, but take whatever the information that is possible without any restriction in the time period. So it says you must look at, as far as possible, the foreseeable future. And the facts and circumstances have to be looked at on a case-by-case basis, difficult to generalize. And the management need to disclose in relation to going concern the degree of consideration they made in assessment of the going concern, what are the areas that they considered, then what are the conclusions they reached, and what are the levels of disclosure that is required so that the users will get the right understanding about the future of the organization. You need to use all available information, and there's no point in hiding information at this moment. As I said, there's no point in trying to show a healthy picture in the profit and loss account, whereas your cash flows are going to be adversely affected. I think the best thing that the management could do at this moment is to consider all available information, all available impacts, and report accordingly. Then when it comes to subsequent events on going concern, the management needs to consider all available information arising from subsequent events, especially 31st December reporters, where COVID-19 was completely may have been considered as a post-balance sheet events. We'll have to consider all available information up to the date of releasing the financial statements, and wherever necessary, comprehensive disclosure will have to be made. 31st March reporters will have many events, many post-balance sheet events, which will have adjusting requirements, and that in turn may have an impact on the going concern as well. So with COVID-19 creating the requirement to incorporate all unexpected shocks and forecasts into the balance sheet, these are few disclosures that which may be required, because especially because of COVID-19. One is what are the risks to new potential uncertainties? So because of COVID-19, there could be new potential uncertainties, maybe about your markets, maybe about your suppliers, maybe about your demand. So there could be new potential uncertainties which needs to be identified and disclosed. Liquidity risk is going to be a key. Almost all organizations may face liquidity risks, and potential defaults and breaches of covenants relating to borrowings. Now, if you have any defaults where you have not negotiated with banks about rescheduling or concessions or anything, then if you default, that would amount to a breach. And as you know, most of these bank offer letters, in very small print, they say that in the event of any breach of covenants, the bank has the right to demand full settlement of the financial facilities, immediate full settlement. In which case, if you breach any covenants, then your long-term loans will become current liabilities. So you have to be mindful about that. And this is very important that, say, for example, a 31st March reporter, say you defaulted in February, and you go to the bank in order to negotiate some concessions. And if you can negotiate and the bank could issue the negotiation letter or the reschedulement package before 31st of March, it will be a pre-balance sheet event. In that case, on 31st March, those loans which would otherwise require to classify as current liabilities can remain in long-term liabilities. However, if your negotiations take time and if the bank issues the letter after 31st March, then the 31st March situation is that you have breached And even if you have negotiated for a reschedulement after 31st March, that would be a post-balance sheet unadjusting event, so that the reclassification from long-term liabilities to current liabilities will have to remain in your balance sheet. Now, most of you might have these kinds of situations at the moment, which needs to be looked at very carefully. And if you have such situation, you may reclassify the long-term liabilities into current liabilities, but after the balance sheet date, if the reschedulement has been successful, then that may become a disclosure item, but you cannot go back and adjust the balance sheet. And specifically due to COVID-19, there may be extended disclosures that would be required. One of the most important items to be disclosed is where you get cash, because your debtors might delay. On the other hand, the suppliers might put pressure for settlement, and the banks are also reluctant to give you additional facilities under the circumstances. So how are you going to manage your liquidity? So liquidity management would be an important disclosure at this moment. Previously, you may have not disclosed or disclosed only very few things under liquidity management, but under with this COVID-19 impact, liquidity management is a key disclosure in your financial statements. And your ability to continue compliance with covenants, contractual agreements, and or regulatory requirements. Sometimes you may not have cash to pay even taxes, so you will breach your regulatory requirement. So you need to make an assumption, an assessment of this kind of circumstances. Can you comply? Can you continue to comply with the bank covenants? Maybe you get a moratorium of 3 or 6 months. After that, will you be able to comply? Will you be able to settle as agreed? All these assessments are required, so that cash, again, that is part of cash flow management, and such disclosures will have to be made in the financial statements. Future demands, again connected to future cash flows and liquidity, will have to be assessed. Assumptions surrounding the length of time and severity to disruption in supply chains. So at this moment, some people say, okay, in 6 months we can come back to normal. Some people say it is 1 year. Some people say it is even more than that. And for some entities, it may be different. Even if the society comes back to normal, for certain entities to come back to normal, it might take different time periods. So that assessment has to be made, and a disclosure would be required of your assessment and the assumptions surrounding the length of time that would be required to come back to normal. And also you need to disclose various supports that would be available, mainly from the government and maybe other international organizations. And if there are any entity specific assistance, financial or otherwise, sometimes it could be in terms of tax concessions, sometimes it could be in terms of various other concessions. That disclosure also is required. So you can see there are additional disclosure requirements are arising because of COVID-19, and the management should get ready to make those assessments and make those disclosures in the financial statements. Now, these assessments, as you have done in the past, it may be very difficult for the auditor to do at the time of the audit, on the last day, on the signing date of the audit. It's not going to work out. So therefore, now itself you need to think about these aspects. All right, so with those two background areas, now we move on to specific areas, starting with the fair value measurement of debt and equity instruments. Now, you know that since last week of March, Colombo Stock Exchange is closed, and it is closed even as of now. So the first problem is on 31st March, you did not have a market value for your equity instruments, listed equity instruments. And even if you had, okay, you may have a market value around 20th of March, when the CSE opened for a couple of days, where we saw almost like dumping of shares. Everybody was trying to sell, and as a result, the market values unprecedentedly came down to very low levels. Now the question is, are we going to take the last available March last available market prices for March, or are we going to look at some alternatives? First of all, let's look at what the standard says. The standard says you have to take fair value in an active market based on orderly transactions. So when you say active markets, there are two things that you need to look at: whether they are having a reasonable volume of trading, and whether those trading transactions were orderly transactions. Now, in both these cases, both these criteria, we have a question mark as far as the CSE operations on the last few operational days are concerned. So having considered this situation, CA Sri Lanka has come up with few practical expedients for the preparers of financial statements. They have permitted you to consider for marketable securities, even if the securities or the instruments are listed equity instruments, still to use a different appropriate valuation technique to measure the fair value of those financial assets. So therefore, this time you don't have to stick to the last available last operating date market prices of CSE. You can look for different valuation techniques to value your equity shares. However, there is a restriction. That is subject to a condition. Whatever the valuation technique that you will use should not result in a value which exceeds the value that you reported on 31st December 2019. Now, when you say to 31st December 2019, certain March reporters may have not published any accounts on 31st December 2019, but you have to look at what would have been the 31st December 2019 market value, and whatever the market value that you arrive at by using different techniques should not exceed 31st December market value. So subject to that condition, you can look at different valuation techniques. And also another practical expedient has been given. If the entities would like, if they are carrying any equity portfolios as trading portfolios at market value, they can reclassify those portfolios from fair value through P&L to fair value through OCI. We know equity instruments, when you fair value, the fair value changes can be recorded either in P&L or in OCI, and that's an election entity will have to make at the beginning of or at the time of acquiring that particular investment. So now what this practical experience say, sometimes because of COVID-19, you may have decided, okay, this problem is going to be there for another significant period, maybe 2-3 years, the market may not revive. And based on that, you take a decision by the management that, okay, these shares we are not going to sell. So in that case, the trading portfolio becomes a long-term equity portfolio. So at that point, on the basis that the business model has changed, you are permitted to reclassify that portfolio from fair value through profit or loss to fair value through OCI. And if you have any portfolio of debt instruments which you are carrying as a trading portfolio, where it would have been fair valued and recognize the fair value changes in the profit or loss, and because of COVID-19, you may have changed your business model and you may have decided, no, I am going to keep these debt instruments until maturity. I am not going to sell. In that case, you are permitted to reclassify your debt instrument portfolio from fair value through profit or loss to either fair value through OCI or to amortized cost. However, having done that, if you change it from fair value through P&L to fair value through OCI or amortized cost, you should not engage in frequent sales, because if you engage in frequent sales, then you will get disqualified to be in fair value through OCI or amortized cost buckets. So those are the things that you need to consider in relation to debt and equity instruments, and there are few very generous practical expedients you may make use of in order to reflect your changed business models due to COVID-19. Then we come to another important area, which is impairment of assets. I think Mr. Rajapaksa also in his introductory remarks referred to impairment of assets. Now, in terms of impairment assets, we know there are two categories of assets. One is where you need an impairment assessment, whether you like it or not, in respect of certain assets. The other group of assets, you need to do an impairment test, impairment assessment, only if there is an impairment trigger. So the assets where you need to have mandatory annual impairment test are mainly the intangible assets, which has or which you have designated to have indefinite useful life, or any intangible assets which are in your work in progress, like say for example development costs on projects which have not yet concluded, and The last one is goodwill, mainly arising from a business combination. Otherwise, you know, you cannot have any goodwill in your balance sheet unless it is resulting from a business combination. So those intangibles will have to be tested mandatorily at every balance sheet date. Other assets, if you take, for example, mainly property, plant and equipment, will have to be tested for impairment only if there is an impairment trigger. Now, what are the impairment triggers? It could be external issues or internal issues. So if you experience reduction in demand, reduction in profits, and external factors such as curtailment of markets for your products, these things might trigger an impairment requirement. So if there are no such impairment requirements, you are not required to have any further impairment testing on those other assets. Now the question is, on 31st March 2020, you have COVID-19. Question is whether COVID-19 is an impairment trigger. Now, in answering this question, you need to look at what are the COVID-19 impacts that you have. Now, COVID-19 is an impact on 31st March, and you are considering whether that COVID-19 impact is an impairment trigger. Sometimes when you do this assessment on 5th of April, you might feel, okay, there is no much impact. But when it comes to end of April, say 30th of April today, you may feel that there is a significant impact. Now your question is, on 31st March, whether COVID-19 was an impairment trigger. At that point, you did not have much information, but after the balance sheet date, after 1 month, you have information to say that it has significant impacts, and as a result, the COVID-19 could be an impairment trigger on 31st March. Now see how post-balance sheet event affected your assessment on 31st March. To that extent, that post-balance sheet event is an adjusting event because you had a question to answer on 31st March whether COVID-19 is an impairment trigger or not. So you need to consider all such subsequent information in that case. So what you have to consider is not only the negatives, but also some positives. Probably there could be certain relief measures provided by the government. And also you need to look at the nature of the assets that you will be assessing for impairment. Say for example, if you are assessing an asset which has a remaining useful life of 10 years. Maybe that asset will get impacted for a year, maybe for 2 years because of COVID-19. Based on the information that we have today, probably we may not have sufficient information to say that COVID-19 is going to have an impact on this asset for another 5 years. So this asset, maybe say a factory complex, so it might come back to normal in another year's time. In that case, 9 out of the 10 years, it will be back to normal. So therefore, when you make your assessment in that nature, sometimes COVID-19 may not be an impairment trigger. However, as opposed to that, if you consider, say you have a stock of raw material. Let's say you have a fabric stock, large fabric stock, and if you don't do something with this fabric stock within a period of 1 year, that fabric goes outdated and you will not be able to use it. Now, how the impairment would apply? Let's say your buyers have cancelled most of the orders and your customers are mainly in USA and Europe, which means you may have sufficient information by now to make an assessment. Okay, I will not be able to make many orders within the next 1 year to USA and Europe, which means this fabric stock will become unusable after 1 year. So there, COVID-19 is creating an impairment trigger on that inventory. So likewise, you need to take into consideration the remaining useful life of the asset when you assess whether impairment triggers will apply. Let's say you conclude that there is an impairment trigger on a particular asset. Now you need to do the impairment test. So in doing the impairment test, you need to determine the economic value, which is the higher of value in use and fair value less cost to sell. Now, when it comes to that stage, what are the issues that you will face? Your value in use calculations may need to be adjusted. Sometimes, let us say, for example, if you are doing, you may be doing an impairment because of an impairment trigger, or you may be making the impairment assessment because you need to do an impairment assessment annually for intangible assets. So your value in use calculations may have to be adjusted. Fair value less cost of disposal may decrease. So most of the things might have changed from the previous year. And there may be a lot of downside effects. So when you are estimating your cash flows for the purpose of calculating your value in use or fair value less cost to sell, cost of disposal, you need to consider all reasonable and supportable information that you have up to now, because you are making the estimates as at the balance sheet date. So if there is any question mark on that estimate, and if the answer to that question becomes available after the balance sheet date, that information needs to be taken into consideration. Management will have to make their best estimate of the economic conditions. What is going to happen? They will have to evaluate whether there are any alternatives. For that fabric stock example, what I discussed a little while ago, they can look at whether there are any alternatives. In that case, there may be a fair value less cost of disposal. And also, you have to look at the positive side, whether there are any fiscal stimulations which will support your case and to some extent might reduce the negative impact. Then you will have quite a challenge in determining your risk-free rate. Yes, interest rates are coming down. Okay, so therefore your risk-free rate might get reduced, which would be a positive sign. But on the other hand, you will have to see what will happen to your risk premiums. Sri Lanka has been downgraded, so naturally your risk premium will go up by a few notches. And also other things that are rising from COVID-19, your market risk, financing risk, and so on and so forth, might adapt your risk premium to offset the positive effect that you got on the risk-free rate. Then the next is you will have to make a lot of estimates and you will have to make a lot of assumptions, and all those needs to be disclosed, and therefore you have to make them in a very methodical manner so that those estimates are logically derived. And when you derive estimates, it is important that you will consider many scenarios. Now, anyway, in these impairment assessments, fair value assessments, there is a requirement to consider scenarios, but now that particular requirement becomes more and more significantly important under COVID-19, because there can be various outcomes, and the management also might be little reluctant to look at the negative outcomes, so they will try to look at the positive scenarios. But what the standard says, you look at all scenarios, positives as well as negatives. Now in this example, just a very simple example, you can see the revenue forecast. You may forecast based on 4 scenarios: positive case, base case, negative case, worst case. Sometimes we are used to make basically 3 scenarios: optimistic, most likely, and pessimistic. So you can see the positive case, the turnaround happens within a shorter period, and when it turns around, it goes to a higher amount of sales or high amount of demand. Whereas the worst case takes the longest time to recover, turn around, and it after turning around also, it's coming to normal is, you can see, very slow. So likewise, you can consider 3 or 4 different scenarios. Then what are the probabilities? What is the probability of the positive case? Maybe under normal circumstances, you would have said, okay, positive case is 40%, 50%, or 60%. But now your positive case is going to have a very low probability. Now that is where you need to consider all information and you have to arrive at a logical answer. An answer that the reader would accept, the reader would believe. Otherwise, you can say, okay, still my positive case probability is 80%, but nobody might believe it. So therefore, these different scenarios may be evaluated, and reasonable probabilities may have to be assigned. And all those processes, the information used, the methodologies and all that need to be disclosed in your financial statements. Right. Then we become, then we come to deferred taxes And the main issue in deferred tax also is connected to impairment. That is deferred tax assets. We know deferred tax assets. Mainly we have deferred tax assets arising from tax losses. And we know tax losses can be claimed over a period of current year plus another 5 years. So in making an assessment of what amount of deferred tax asset can be recovered through future profits, we need to make an assessment of future profits, a forecast of future profits. Previously, in previous years, when we recognize these deferred tax assets, we may have forecasted our profits in the normal manner. And based on those forecasted profits, we would have determined the amount of tax losses that could be claimed. And based on that, a deferred tax asset would have been recognized most of the cases as part of the tax losses, not for the full amount of tax losses. Now what happens because of COVID-19, our profit forecasts are going to be changed. At least for another couple of years, or maybe even more than that, profit forecast might change. Now we need to make a fresh evaluation of our profit forecasts. Based on this fresh evaluation, we might find, okay, out of our tax losses, a certain amount cannot be recovered. In that case, the deferred tax asset that we have already recognized in relation to that unrecoverable tax loss amount now need to be written off because that amount of deferred tax asset has impaired. So because of this COVID-19, this kind of issues might be aplenty. So therefore, the management need to make an assessment of their future profit forecasts. However, in doing so, you need to look at various relief packages offered by the government. Sometimes the government might come and say, okay, your tax losses can be recovered not over 6 years, but we'll give you 8 years, 2 more years. So that also has to be taken into consideration, right? And certain expenditure you have incurred, maybe certain donations and various other things. Sometimes you might get indefinite time period to claim reliefs. Then that may be taken into consideration. I have given some of the things that have happened in other countries, right? We might also follow that. That may be relevant. Then when it comes to liability side, deferred tax liabilities, you may have to reassess. Certain investments may attract accelerated depreciation. So that might give rise to additional deferred tax liabilities. So you have to be mindful about that. So therefore, mainly in relation to deferred tax assets and also any impacts arising from COVID-19 in your deferred tax liabilities will need a reassessment of already recognized assets and liabilities, and will need to assess any new deferred tax assets and liabilities that may arise, and accordingly you need to recognize them in your financial statements. Again, if we bring back here the post balance sheet event principle, are they adjusting or non-adjusting? Now, in the case of deferred tax assets, when you need to forecast profits, that issue or the question mark was there as at the balance sheet date. So therefore, if any information that you get hold of after the balance sheet date, which will assist you to determine your profit forecast, then you have to go back and adjust your profit forecast, and in turn go back and adjust your deferred tax assets. Right, now we come to financial instruments. This section mostly will be relevant to banks, but will have some relevance to non-bank institutions also. Otherwise, it would be more relevant to banks and financial institutions. We know that every one of us are talking about certain moratoriums and grants, concessions extended by the government. Mainly, in this respect, the central bank circulars 4 and 5 would be relevant, where these circulars have extended for performing loans a moratorium ranging from 2 to 6 months, and for non-performing loans, provided they will fall in line, certain waivers and repayments. Now, in this respect, when it comes to financial reporting, there could be certain modification losses to be recognized by the financial institutions as a result of these concessions granted. And in some cases, interest rates may have to be revised, effective interest rates may have to be revised. And all those considerations will have to be estimated based on forecast cash flows. So therefore, in determining the accounting treatment for these moratoriums and various other concessions granted, the change that is going to take place in respect of cash flows connected to the facility given by the financial institution will be the most important. I would say everything else, of course, you need to follow accounting standards, but everything else are going to be book entries whenever you make. So determination of those amounts are going to be based on cash flows. We will look at some of those provisions. However, CA Sri Lanka has given a practical expedient in relation to working capital loans, which are supposed to be granted at 4% to the customers. Now, generally, 4% is a very low rate of interest in Sri Lankan context. And when we have any loan facility below the market rate like this, the standard generally requires us to fair value the loan based on the market rate. However, the practical expedient given is that this working capital loan, which is at 4%, that 4% rate of interest is considered the market rate for this type of loans. So therefore, a fair valuation is not required. So having said that, when we come back to the moratoriums granted, in respect of performing loans, we know that performing loans are in either stage 2 or stage 3 anyway. The conditions of COVID-19 is on its own not going to result in a significant increase in credit risk. Therefore, simply because of COVID-19 as an event, a loan is not going to increase the credit risk of the borrower, but you need to assess, as a financial institution, you need to assess the borrowers, the other factors surrounding the borrowers to see whether there is a significant interest in credit risk. But however, based on several discussions, the general understanding now among the banks is that until next December, that is December 2020, for interim periods, they are not going to consider any increase in credit risk simply because of COVID-19 alone. Of course, if the borrower has different reasons to increase his credit risk, that is a different matter. But alone based on COVID-19, no significant increase would be considered. So therefore, the borrowers are going to remain in the current stage, whether stage 1 or stage 2. And as a result, either the 12-month expected credit loss or lifetime expected credit loss will apply depending on the stage. And in these two stages, the interest revenue is going to be recognized at effective interest rate based on the gross carrying amount of the loan. However, because of these moratoriums and concessions, if the loan is going through a significant or substantial modification, then sometimes a modification gain or loss may have to be recognized, or otherwise the effective rate of interest may have to be revised. Let's look at an example in a couple of minutes after going through the non-performing loans. Now, when it comes to non-performing loans, we know anyway non-performing loans are in stage 3. So it will remain in stage 3 and interest would be recognized on the net carrying amount using the effective rate of interest. However, the cash flows that were considered in determining the expected credit loss of these loans, COVID-19 may have had an impact, and those cash flows of the borrower may have to be revised. In that case, the expected credit loss that may have been already recognized on stage 3 loans may have to be relooked at. So estimated cash flows will have to be relooked at, and if you find that because of COVID-19 the provisions have to be increased, then additional expected credit losses may have to be recognized. Okay, let's look at quickly an example on this moratorium. Let us say a loan has been granted on 31st March 2020, 1 million to be repaid in 12 months at an annual rate of interest of 16%. So in this particular case, the monthly installment can be derived from the annuity using annuity tables to be 90,730. So the original payment plan of this loan was starting from 30th April 2020 up to 31st March 2021, 12 installments. But now because of the moratorium, this will get pushed back. So the first installment would be paid after 6 months on 31st of October 2020 and will go on till 30th September 2021. And the borrower will pay 12 installments. Now the revised amortization schedule will look like this. However, the banking industry has been having a different view on this. I'm not too sure by now whether the central bank has clarified whether the banks could charge any interest during the moratorium period of 6 months, or whether the revised amortization schedule will have to be like shown in this slide. The verbal explanation of central bank is that it should be like this, and the banks are not permitted to charge any interest during the moratorium period. Okay, never mind if there is any interest charged during the moratorium period, all that will be considered on cash basis and will be taken into consideration in the amortization schedule in calculating these numbers. Now, based on this amortization schedule, if you calculate the revised EIR, effective interest rate, that will come to 8.22% per annum. If you calculate the present value of the 12 installments based on the new timing, that will be 923,604. So considering that 923,604 against that 1 million, the capital outstanding, you can see a difference of 76,396, which is considered, which is termed as the modification loss. Now, how are you going to treat this modification loss? The bank will have to evaluate this particular loan and will have to see whether this modification is a substantial modification or not. When you evaluate whether the modification is substantial, apart from the amount that you are going to lose in present value terms, you will also have to consider whether there are any conditions that would be changed in the loan agreement, whether there are other reschedulements, any changes to the covenants, and so on and so forth. Considering all that, if the bank concludes that the modification loss is a substantial modification, then according to the standard, the previous loan has to be derecognized and a new loan has to be recognized. When you recognize the new loan, you will be using the new effective rate of interest. So basically, if the modification is substantial, then the bank will recognize a new loan at 8.22% per annum. A new loan of 1 million, which is the remaining capital outstanding, at an interest rate of 8.22% per annum. However, if the bank concludes that this modification is not substantial, then the modification loss has to be recognized immediately. So 76,396 will have to be recognized in the P&L, but the loan will remain as a 16% loan, and at that rate, the interest would be charged at the net carrying amount after providing for 76,396. The loan will become now 923,604. On that, you keep on calculating interest at 16%. So it will be like this. If you change the effective interest rate, your amortization schedule will look like on the left-hand side table. And if you don't change the EIR, which means it is not a substantial modification, but you will recognize the modification loss, then your amortization schedule will be like this. If you recognize a new loan, then you can see based on the new EIR, over the period of the loan, you will be recognizing an interest of 88,770. But if there's no substantial modification, and if you recognize the modification loss, then over the next 18 months, you will recognize an interest of 165,166. But don't forget the fact that you have already recognized a modification loss of 76,000. So when you net off those two, still your interest revenue is 88,770. So you can see over the period of time, there is no difference in the interest revenue that you recognize in your P&L. It is only a timing difference. And also you can see from a cash flow point of view, the installments that you recover from the borrower, the amount and the timing, there is no difference. You can see the payment column in both tables, that is identical. So what is important at this stage is that what you are going to receive in cash. So the timing of cash, irrespective of the moratorium, timing of cash is not different. Amount of cash is not different. So what is different is our calculations, the amounts that we are going to recognize in P&L, which are all book entries. But the amount of cash is not different in both cases. Whether the change is substantial or not, whether you recognize a modification loss or not, whether you change the EIR or not, all other things are same. Cash flows are same. Okay. Then there are a few more practical experience allowed by CA Sri Lanka in respect of segmentations, expected credit loss assessments, and especially on those two, segmentation of portfolios and expected credit loss assessments. So as I already discussed, significant increase in credit risk may not arise simply due to COVID-19 alone. So as a result, the staging, whether you are in stage 1 or stage 2, will not change. And cash flow forecast estimated as of 31st December 2019 for individually significant loans may remain until 31st December 2020. Now, please note that these practical expedients have been allowed only for interim financial reporting during the year 2020. So therefore, March, June, and September, this practical experience will apply. But when it comes to December 2020, then you will have to make reassessments. In the event of reasonable and supportable information are not available, PDs and LGDs as at 31st December 2019 may be used. Now, when you prepare your interim financials end of March, end of June, and end of September, if you don't have sufficient, reasonable, supportable information to re-estimate your probability of default or loss given default, the same numbers that you used on 31st December 2019 may be used. However, you know, COVID-19 has created some impact, even though we might not be in a position to quantify. we all know that it has made some impact. So therefore, this practical experience say that because you are not changing your PD and LGD for the next 3 quarters, at least you consider changing your scenario probabilities in the economic factor adjustment. Now, you know, economic factor adjustment, we normally take an optimistic, most likely, and pessimistic scenarios with probability weightages. So this suggests that some probability from the optimistic and most likely scenarios be shifted to pessimistic scenario, so that whatever the adjustment which may have not been captured because of non-revision of PD and LGD may be captured, even though it is not going to be 100% accurate, may be captured at least on the probability shifting or weighted shifting in EFA calculations. And also another practical expedient is, if there are any write-offs that may arise from COVID-19 for mainly stage 3 loans, in future, when you are calculating the LGD percentages using these numbers, you may exclude write-offs that you made because of the COVID-19 impact. So there are very generous practical expedients that have been given, and the practical expedient that have been given for individually significant loans will apply to non-banking institutions as well, in respect of application of simplified method for outstanding borrowers and outstanding contract assets. There are additional disclosures that would be definitely required because of COVID-19. Particularly, we said that practical expedient allows you to use same PDs and LGDs as of 31st December 2019. In that case, so that is, if you don't have supportable, reasonable, sufficient information for the quarterly assessments, then you need to explain in disclosures why you say that you don't have sufficient information for the quarterly assessments. So there are various disclosure requirements that you may have not done previously, but arising purely because of COVID-19. So the management need to be geared to make these disclosures at the time of COVID-19. Because of COVID-19 at the time of releasing or preparing their financial statements. Moving on to leases, as I said at the beginning, most of the lessors and lessees are negotiating for concessions on leases. Now, how are you going to recognize these concessions on leases in the financial statements under IFRS 16? Now, as a result of these concessions, we know that there is going to be a change to the original terms and conditions of the lease contract. However, we need to consider whether this change is giving rise to a modification in terms of IFRS 16. If the change is giving rise to a modification, the treatment is one. If it is not a modification, then the treatment is different. Okay, how do you first of all determine whether it is a modification or not? A change in the lease arrangement to be a modification, then the lease arrangement, the change has to result in a change in scope or change in consideration. What do you mean by change in scope? Either a change in the asset or change in the lease term. Say for example, you have rented, maybe for your office, maybe for your business, you have rented 5,000 square feet of space from a lessor. Because of COVID-19, you now find that you are doing most of your business from home and using technology, and as a result, you find, okay, this is a good method, I probably can continue. In that case, I need only 2,000 square feet of office space. Now you negotiate with your lessor, and luckily lessor also agreed to reduce the office space to 2,000 square feet from 5,000. Now that is a change in the asset and change in the scope. Or else there could be a change in consideration. You go and tell the lessor, okay, I don't need 5,000, I need only 2,000. But the lessor says, okay, now I don't have anybody to give the balance 3,000. But what I'll do is, I will give you a 40% discount on the rent. You keep the entire 5,000, but I'll reduce the rent by 40%. So that is a reduction in rent, which is a change in consideration. However, please note that if the lessor says, all right, because of COVID, you will have a difficulty. So for the next 3 months or next 6 months, I will not charge you any rent. But what I will do is, I will add those 6 installments to the remaining lease rentals, or I will extend the lease. I will add it to the remaining lease rentals and recover it from you. So that doesn't mean that there is a change in consideration. Of course, there could be a time value of money, but in terms of leases, there is no change in consideration. So that will not qualify here. So if you satisfy any one of these 2 conditions, that is, either the change is giving rise to a change in scope or change in consideration, and then you need to look at whether that change was made because lease contract covered it. Let us say, for example, somehow at the time of entering into the lease contract, you had foreseen this type of a problem, and there was a clause in the lease agreement to say, in a situation of an epidemic, the space would be reduced on the request of the lessee from 5,000 to 2,000 square feet. Something like that, some clause like that. Or there would be a discount of 40% in the rent. So if there was some clause in the lease contract, then you will not consider it as unexpected. The whole thing is that if this is to be a modification, this has to be an unexpected change. So therefore, if the scope change or the consideration change is arising as a result of a clause which is already in the lease contract, then it will not it will not be considered as a modification. But if the lease contract did not have any clause, but simply because of this COVID-19 incident alone, there was a change in the scope and change in consideration, change in scope or change in consideration, but there was no clause in the lease contract, then it is considered as a modification. So if it is a modification, then the standard says you will have to remeasure the lease liability, which means you will have to consider the new rentals, new period of the lease, and also new discount rate, and do the revised calculation on the lease payments. So when you do the revised discounting and the present value calculation, then you will have the new lease liability. So from the carrying amount, the difference would be debited to the lease liability, and that amount would be credited to the ROU asset, and thereby adjusting the liability and the asset, the change or the modification would be recognized. But if the change is happening because there was a clause in the lease contract, or the change is not a change in scope, or change is not a change in consideration, then you don't consider that there is no modification. In that case, whatever the impact is recognized in P&L. All right, in this case also there are few practical expedients. The practical expedient is that an entity may elect not to assess whether a COVID-19 related rent concession is a lease modification or not. This whole thing what we discussed, this practical expedient says an entity might ignore. They will elect not to assess whether the COVID-19 related concession, whether it is a modification or not. I am not bothered. I am not going to assess, provided three conditions are met. What are the three conditions? Revised consideration based on revised lease payments are substantially the same or less. Which means, in other words, the rents may have been postponed a little bit, but overall, there is no substantial difference between the old total rent and the new total rent. The reduction affects only payments originally due in 2020. Now, this reduction is not going beyond 2020. It is affecting only for those payments which were originally scheduled for 2020. And the third condition, there is no substantive change in other terms and conditions. So other than these few concessions, there are no changes into the clauses of the agreement as far as these concessions are concerned. So if those three conditions are satisfied, and if the impact is going to be only in 2020, then the entity may elect not to assess. He will not be worried to assess whether the change is a modification or not. Okay, so we have discussed all the key areas. Then there are few miscellaneous areas. One is onerous contracts. An onerous contract is a contract where the fulfillment of remaining obligations will cost you more than the anticipated economic benefits. So generally, under normal circumstances, we have to make provisions on onerous contracts. But the special nature here is, because of COVID-19, even normal certain normal contracts could become onerous because of the COVID-19. Because we know, for example, certain construction contracts have to be stopped. In that case, again, when you resume, you may have to incur more costs. Or during the period of suspension, you may have, as a contractor, you may have to pay your people. So there could be a cost escalation. So as a result, a non-onerous contract could become onerous contract because of the COVID-19 impact. So you have to be vigilant about it. And if that happens, then a provision would be required on these onerous contracts. Then if your various revenue contracts has variable consideration, these variable consideration estimates might change now. For example, discounts, refunds, price concessions, the total amount during the total contract period might now change because of the COVID-19 impact. So that if that happens, you have to be mindful about it, capture it, and make any changes to the estimates if required. Then sometimes you may have taken insurance policies to cover loss of business or loss of profits. Sometimes those policies might have covered this type of COVID-19 type of incidents, events. Sometimes there may be in small prints something to exclude this type of events. So you have to be very careful, and accounting standards say that until your insurer confirms that you are entitled to a claim, and unless that claim is confirmed, don't recognize it as a receivable in the balance sheet or as an income in the profit or loss. Even if it is allowed, then we know in this type of insurance policies, generally what they compensate you is for your fixed costs that you incur during this period. In that case, if such related costs can be identified, those related costs should be offset with the insurance recovery. When it comes to borrowing cost, a question asked always is, when a contract is suspended during this idle period, can you capitalize your borrowing costs? No, you can't capitalize your borrowing costs. So therefore, if you have any projects where borrowing costs are capitalized, and if those projects are suspended, then capitalization of borrowing costs should be ceased. In respect of inventories, net realizable value calculation could be a change. So depending on whether post balance sheet information would provide sufficient information for the NRV estimate, such estimates may be changed later when the financial statements are released. And more importantly, when you are allocating fixed production overheads, we know fixed production overheads will have to be allocated based on normal capacity or the normal production level. So if your factory is idle these days, then that idle time cost cannot be allocated to your normal production. So such unallocated amounts must be written off to the profit and loss account, because these days either your factory may not be working, or sometimes maybe the factory is working under capacity. So therefore, that under capacity level cannot be considered as the normal capacity level. Production overheads must be absorbed based on the normal capacity. So whatever you cannot absorb should be written off as an expense to the P&L. Right, ladies and gentlemen, so that is all what I have at the moment. Of course, as I said earlier, information coming every hour, so there may be some more information available now if you go to certain websites which were not there when I started this presentation. So that's the speed in which information are coming up. So you have to be keep a track of all that information to see which is relevant for you, and in that case embrace that and use that information in making your balance sheet date estimates. So thank you very much for joining this presentation, and now it's time to take up some of your questions.
Thank you, Nishan. Can you hear me?
Yes, sure.
Yeah, thank you for your wonderful presentation. It was very informative, and I'm sure that all of us have now a better understanding the financial reporting implications of this crisis. Sufficient time and attention may have to be paid on the areas spent on the areas that you've highlighted, just to ensure that the financial statements give a true and fair view of the performance and position of the company. This is very important because at the end of the day, we have to ensure that the financial statements give all the important information to our stakeholders, specifically the shareholders, to make informed decisions. Having said that, I would now like to, some of our participants have posted a few questions, just one or two questions. And one of the questions that they have is, of course, do we have to disclose any concessionary loans obtained from central bank subsequent to the year end, that is 31st March? Do we have to disclose any concessionary loans obtained from central bank subsequent to 31st March 2020?
Yeah, I think if the loan is obtained subsequent to the balance sheet date, it's a balance sheet day, a post balance sheet event, and directly it might not have an impact on an estimate made in the balance sheet. But in the discussion on the going concern, I said that in the going concern assumption, these concessionary loans could be a key factor. These concession now at the time of going concern assessment, or in an impairment assessment, when you are assessing the cash flow position, continuity of a particular cash generating unit, the cash flow concessions that are arising from this loan would be relevant. Right. To that extent, there are certain estimates in the balance sheet, even though not quantitative, sometimes maybe qualitative assessments in the balance sheet, which should have an impact from this post balance sheet concessionary loan. Right. So therefore, I would think it would be relevant to disclose these COVID-19 related concessions, whether it is a loan or whether it is something else, which has been secured after the balance sheet date, to be considered, to be disclosed in the balance sheet, in the financial statements.
Right. Another question that was asked by one of our participants is, if refinancing, waiver or amendment to a long-term financing arrangement is agreed after the balance sheet, so you basically amend the long-term financing arrangement after the balance sheet date, how does it impact the financial statements as at the balance sheet date?
Okay, again, what I said in respect of the first question would still be valid. Right. Because even though this has been negotiated after, say, the cash flows of the original loan may have been considered in the going concern assessment, liquidity assessment, impairment assessment, and so on.
Right.
So to that extent, it would be relevant, but strictly speaking, if you ask me whether the balance sheet number has to be restated, it doesn't have to, because to that extent, it's a post balance sheet event. Because as of the balance sheet event, the liability was the old liability.
Right. Okay.
So number will not change, but disclosure would be pertinent.
Right. There is another question. I think you, if I'm not mistaken, you already covered this in your presentation. Explain the treatment pertaining to investment in shares. That is, of course, I think if we TPLs.
Yeah, investment in shares. Now, when you say shares, it could be of two types: quoted and unquoted. Right. Unquoted shares, anyway, you would have applied a particular method of valuation, fair valuation. Right. So that same method can continue. However, the cash flow forecasts need to be relooked at, because those cash flow forecasts used for the previous year valuation may need to be revised. When it comes to listed securities, in a normal situation, we would have used the 31st March market values, and if the CSE did not function on 31st March, we used to take either 30th or 29th or the last working day valuations. But under COVID circumstances, there are two practical experience. One is you are permitted to use a different valuation technique. If you want. For example, I mean, you might not do it if you have only about, say, 10,000, 100,000 shares. But if you have a sizable stake, say 20-25% in a listed company, which had to be fair valued at traded price, now you may want to relook at it and apply say a cash flow forecast technique and value it differently. But however, this restriction is there. You cannot value in excess of the value you reported on 31st of December.
Yes, 31st. Okay.
Right. So if you really consider between 31st of December and the last date of trading in the stock exchange, okay, there might have been a certain decline, but whether that decline is significant enough for you to go for a different valuation technique has to be evaluated by the management.
Right. This other question is on disclosures. What's the level of disclosures to be given or to be made on business interruptions on post-balance sheet scenario? Should it be quantified?
Quantification may be difficult in the first place.
Yes.
But the level of disclosure is that a reader of financial statements should be able to evaluate about the going concern of the entity. So to that extent, the management need to discuss anything which is having a significant impact on going concern. Then if there is anything affecting impairment which has not been incorporated into the balance sheet date impairment models, need to be disclosed, because those impairment values will have an impact on the balance sheet date net asset valuation.
Right.
Then on the other hand, anything affecting the general outlook, any actions that have been taken by the management with regard to the COVID-19 response strategies.
Right. Because I think companies already have a difficulty in understanding the short term, let alone the long term impact of this crisis, and trying to forecast for more than.
The companies will have to disclose short term liquidity management strategies.
Right. So there was one other question. Will there be any impact on the value of bonds as at 31st March 2020? Do we have to impair these assets? I think you touched on this during your presentation. You're talking about available for sale. These, I think, OCI assets.
Okay. Impairment. Actually, when it comes to bond, if it is rupee denominated bonds, the values must have gone up because the interest rates came down.
Right.
So therefore, the values would have gone up. The problem will be in respect of dollar denominated bonds.
Right.
Because of the downgrading of the country rating.
Right.
There could be some kind of impairment, but again, I don't know whether the question came from a bank or not. In the case of bank, I think there is a now consensus between central bank, the banks, and the CA Sri Lanka that again for dollar denominated bonds also certain variables used on 31st December 19 would continue to be used until some significant new information would arise, because everybody thinks that current situation is a panic situation. Even the exchange rate depreciation is a panic situation.
Right.
So because of that, December 19 variables may be used until some reliable information is available.
Right. So I think we can bring this session to a close. We have all answered all the questions. And if any of the participants require any clarifications or you have any other questions that you wish to ask, you can get in touch with Nishan Fernando. I think his contact details are given on the slide. You may even contact Buddhi, who is the senior manager in the BDO Consulting Services division. So we would like to thank our presenter. Thank you, Nishan, once again for your wonderful presentation, and to all the participants for joining us today. Have a great day. Enjoy the rest of the day and stay safe. Stay safe. That is what is most important. So take care and be good. See you. Bye.
Thank you. Thank you very much. Thank you very much.